Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, one of the surprising omissions in the interim finance minister's interim budget speech was the complete absence of any reference to recapitalization of public sector banks, PSBs. Given that the poor health of PSBs is considered to be one of the biggest impediments to faster economic growth, what explains the silence? Does it mean that the worst is over for PSBs and they will not need any more taxpayer-funded support? After all, 3 PSBs have come out of PCA. Or is the government just hoping that if they ignore it, the problem will simply go away? To help us read between the lines and decipher what this means for the future of PSBs, I have two stalwarts from the banking sector with me. G. Padmanabhan, former Executive Director, Reserve Bank of India, who as ex officio Chairman Bank of India presently, has seen it from both sides, the regulator and the regulated. And Madan Sabnavis, Chief Economist, Care Ratings. Welcome to the show, Madan, Padmanabhan. Let me start by asking both of you in turn. Are you surprised by the fact that the budget speech just glossed over the issue of recap bonds for PSBs? How should we interpret the silence? Let me start with you, Padmanabhan.
Mythili, whether I am surprised, probably not, because I would think that the capitalization of the public sector banks in any case is fisc neutral. So it's a question of making an announcement. I don't think it has any impact as far as the fisc is concerned. Now, I would like to state 2-3 other points as well. First of all, I think the government, if my calculation is still right, still have about 50,000 crore left in the kitty from whatever they set apart or they decided to recapitalize in the past, number one. Number two, as you rightly said, some of the banks have come out of PCA, so the things are starting to improve. But there is another important aspect that is happening as well, which is the consolidation. So, and consider that along with the fact that this is an interim budget. So, come the full-fledged budget, I think by the time the position would be clearer as to whether this merger of these 3 banks they initially announced, that is really on course. The second thing is, are there any new decisions that are getting taken? And it's just a question of making an announcement. I think as a bank which received timely support, I think twice last year from the government, which exactly enabled us to come out of the PCA. I don't think capitalization is an issue which is getting lost. Probably it has not been stated, made an announcement is not made, but it is very much on the card. And the final point that I would like to make is, I think the public sector banks, as we go along and things start improving, cannot be every time depending on the government funds. We need to have our own capital raising plans, and at least as far as my bank is concerned, I can say that one thing which was holding us back was the PCA. Now that we have come out of the PCA, yes, we would be looking up to the government when we need funds, but I think that will not be the only source that we will be looking at. We would be going to the market to raise funds as well.
Madan, would you agree with Padmanabhan? Because though he said that actually recap bonds are fisc neutral, they're not entirely fisc neutral because there is an interest cost that does impact the fisc. Also, the recapitalization only addresses the stock of NPAs. It doesn't really address the fact that we are going to see a continuing flow of NPAs. Also, past budgets repeatedly mentioned recap, even though it was fiscally neutral to the extent apart from interest rates. So, would you agree with Madan, or are you surprised that the government didn't say anything at all about recap? Was it just a smart move?
No, in fact, I was a bit surprised that there was no mention made about recapitalization, because given the fact that it is fiscal neutral except for the interest component, there will be no harm in making such kind of mention. So I think the underlying assumptions here are, I think, something which have been covered by Mr. Padmanabhan, which I would agree with him, is that maybe some of the banks are turning around the corner, and that's what you're hoping is going to take place. And we can also think of some more mergers taking place, because a merger is one way in which a weak bank can be capitalized by merging with a stronger bank. But I think the more important issue, I think something which we have left out right now, is that there is a bit of debate about what's going to happen to the RBI's reserves, and the committee is supposed to submit its report in March. So it's probably hoped that maybe based on the recommendations, in case there is some money coming from the monetization of the reserves of RBI, some part of it could be used for recapitalizing banks, and that could could come about in the main budget. So I think the issue is being sort of kept at the sidelines for the time being, hoping that things will work out in the next 3-4 months. But I think the critical part will be whether the RBI reserves could be used for this purpose.
Okay, so we're always living in the hope that things will improve. That is true. But Padmanabhan, the fact is that many, including in fact, learned observers, in fact, have often argued that one of the reasons why the recap bond amount is so large is because of the RBI's insistence on Basel Plus standards. And RBI has defended this on the ground that bad loan recovery is so much more difficult in India. But the reality is that there is considerable scope for discretion in how banks compute capital adequacy. So should we tailor Basel norms to our ground realities instead of blindly following Western models? And would you agree with that? And can we read the silence on PSB recap as a signal that there might be some rethinking on this? The former governor was very much against it. But is there some possibility of rethink on this, Padmanabhan?
Mythili, my personal view on this as follows. I think probably we need to have a bit of a difference between the banks which have international operations and the banks which are purely domestic, which are small in size. But having said that, I think having gone along the Basel path for so long, I don't think we can sort of retrace at this point of time, which will be sending completely wrong information or the direction to the international investors. So I wouldn't go along the path of saying that we completely retrace from the Basel norms, but there is probably you can nuance that a bit depending upon what's the kind of banks that you are looking at. Having said that, I think one of the reasons is there in the question that you raised yourself while you were explaining is that now that the resolution process is going on, one big thing that could happen if things go along the way that we hope, we bankers hope will happen, is that once this resolution process really started speeding up, I think the banks which have made aggressively, who have aggressively provided for, and I would think that my bank is one of them, given that the provision coverage ratio as we speak is above 75%. So we would be able to, have a situation where these are getting returned back and the position will improve. So I think just by making mention of this, I don't think this issue is being lost sight of. I'm not very certain that whether the RBI reserve is going to come along or not is going to be the basis on which the government will take a decision whether the capitalization has to happen. The capitalization has to happen, it has to happen, and it has happened in the past.
Absolutely. We'll come back to the issue of IBC a little later, but sticking to the issue of recapitalization, how capital adequacy is calculated, Madan, for instance, would you agree that risk weights could be lowered, provisioning requirements could be phased out for mark-to-market treasury losses, and all this would help lower the amount of capital needed? Also things like, liquidity coverage ratio, a stable funding ratio don't make very much sense in the Indian context where we have SLR and the bulk of deposits is from the retail sector in India. Madan?
No, I think once we have decided to follow the BAL norms, whether it's 1, 2 or 3 as it is today, I think there's no point in actually retracing it, because it looks more kind of an afterthought, saying that merely because we have reached a situation where certain banks have a problem in terms of providing capital, therefore we should start diluting the norms. I think this kind of thing should have been thought about earlier, and I think the moment we do so now, it would actually send a signal that merely because the banking system has a certain amount of stress which is coming in, and there is a certain amount of flexibility available on account of certain inherent strengths which are there, like you had mentioned about the CRR and the SLR. Now tweaking the norms, to my mind, may not really give the right signals.
Well, yes, you have a point, both Padmanabhan and Madan, you have a point in that, it's not very good to keep rethinking things. But sometimes as the situation evolves, I think it's important also not to dig your feet in and say that we are not going to change. And Padmanabhan, to come back to the idea of your suggestion, is it really possible to think in terms of differentiated capital requirements depending on the kind of operations? So, for instance, we can have only those banks that have international operations comply with Basel, and all other majority government-owned banks being given some kind of leeway, something that you suggested, with the caveat, of course, that they go through the Basel compliant norm banks for their opening letters of credit and so on. In fact, this was a suggestion that was made by the Narsimham committee, because they said you have 2 or 3 international banks and the rest can be domestic banks. So do you think this is something that we need to think about, because India would not be the first country to tweak Basel norms? Padmanabhan?
No, I personally think that's something that we could think about. But having said that, how this will work in practice, I think there needs to be a debate on that. And to my mind, it should be possible that wherever we have international operations or large banks, and we are increasingly moving towards a scenario, if you take on board the fact that the government is seriously looking at merging some of the banks into larger entities. So, there would definitely be a set of banks who have large, who have international operations, and the other set of banks who are purely domestic or regional banks. To my mind, you could think about two different set of norms. Yes, the way that they could be having operations through these banks for their foreign exchange or international operations, but that is something which can be always nuanced.
Madan, do you think the idea of differentiated capital adequacy norms could be an option?
See, it is theoretically an option, but I would not go along with it, because I think when we are talking of capital norms, it's essentially from the point of view of the system. So maybe if we have an international norm of 8% and we are following 9%, we can say we can come down to 8%. But I don't think we can say that merely because you're an international operation, you need to have 10, somebody else has 7, somebody else has 6. I don't think, because I think it's from the point of view of the integrity of the system and not from the point of view of the kind of bank which you have. So while differentiated banking definitely does make sense, but in terms of capital norms, I think the norms should be the same. It's something like saying that, can I have a pass mark for a urban school to be 40% and for a rural school to be 30%? Well, I would leave it at this analogy.
Okay, certainly there is a case for discussing this a little bit more, because we do have differentiated bank licenses. So why not differentiated capital adequacy? But I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with two stalwarts for the banking sector, Padmanabhan and Madan Sabnavis, on the rather puzzling silence in the budget speech about recapitalization of public sector banks. Padmanabhan, if I can now shift to the Reserve Bank of India. Is the Reserve Bank of India's mandate, in terms of which a resolution plan must be implemented within 180 days from the first date of default, and in case a resolution is not implemented, lenders should file an insolvency petition within 15 days of expiry of that period in cases where the bank's exposure exceeds 2,000 crore, a bit unrealistic, particularly in the case of MSMEs, where delays by government departments and large corporates is often the reason for their defaulting, and such insistence will only worsen the position, particularly of public sector banks, as they will have to make a higher provision the moment they file for insolvency. So is it a case for the Reserve Bank of India also being a little bit more pragmatic? Padmanabhan?
Well, I think Mythili, having driven policy from the Reserve Bank of India for more than 3 decades, I would say that any change that is being brought about as far as the system is concerned would be resisted by the system. And ultimately, I think people will get used to this. I make this statement because please remember, if I step away from the topic that we are discussing for a few seconds and say that, take the case of the payment systems. When we had the checks which were getting realized over 2 weeks, we still used to have a special clearing run on March 31st for the income tax to be paid. When there is a real time settlement happening, even then we are having the system to be. What will happen if this is closed and we say that there will be no special clearing, tax will have to be paid before, there will be hue and cry, but the tax will get paid. So, I think that ultimately the system will get used to this. Now, you are on a second issue. The second issue is whether this particular norm needs to be tweaked or thought through differently as far as the MSME is concerned. Given the very basis of their working, I would probably go along with the argument that there is a need to look at it differently, and that is probably why I think periodically every now and then Reserve Bank has been giving special dispensation. So, again we go back to the issue that if we accept that there are different segments in this market which work completely in different way, the need for differentiated regulation needs to be thought through, and one broad brush approach may not work.
Oh yes, that is a very welcome admission from our former regulator, because we haven't seen that kind of nuanced approach from the Reserve Bank of India. Because Madan, now if I can just shift to both IBC that Padmanabhan and you were both very hopeful about, because in theory liquidation does enable faster recycling of capital, and that was the hope really when the IBC was launched, that it would enable faster recovery and hence faster recycling. But that is not what we are seeing with the cases getting stuck in litigation for months on end. Also, there is no certainty that the party whose bid is finally accepted will be really able to turn around the company. In fact, we have seen cases like Liberty House where the winning party is now not willing to honor the terms of the bid. So, liquidation should be the very last option, especially in a capital scarce country. So, should RBI's norms once again be tweaked to reflect the new learnings post IBC? Madan?
No, I think this is not going to be an easy issue. I think even when we had the IBC coming in, and we had those 12 large cases coming in, and some of them had some limited success, there was a bit of euphoria which was there at that point of time. But we should remember that resolving bad debts is not an easy issue. It's not been done for the last 20 years. So it's no reason why one can expect it to happen very fast. But I think having a system in place is what the RBI and the government have worked together. And I think things are going. And we've also seen that the February 12th resolution was something which has created a bit of controversy about whether things should be pushed into the IBC immediately once the default comes in. But I think it's a matter of time before this gets resolved, but we should not be expecting quick resolutions or high recoveries, because I think when we had certain cases where the recovery rate went up to 60 to 70%, it was felt that that could probably be the norm. But I think we are still struggling around the region of around 20-25%. So I think time will be of essence, but it's good that we have this process in place. And I think one can be a bit sanguine that things will work out in the next couple of years.
Oh, absolutely. I think we're all sanguine. But I think in the interim period, one needs to be a little pragmatic. Take a step forward and think what are the implications and then take the next step. But I'm not very sure that the RBI has been doing that so far. But Padmanabhan, also when moved to the issue of PCA banks, yours was a PCA bank, and a lot of hope seems to be found in the fact that 3 of the 11 PCA banks have now emerged from PCA. Given that the choice of the criteria for determining PCA status is to my mind somewhat arbitrary, and as was the medicine that was administered to these PCA banks, how much of a difference does this really make the escape from PCA, both for the banks themselves and the larger macroeconomy? Will we see a marked improvement in credit offtake, which is ultimately what the purpose is? Padmanabhan?
Okay, let me answer this question with reference to my bank. I think we did not have a blanket, ban on expanding the credit. We were asked to get into the investment grade credit, and that created a bit of a problem because this rating itself is an issue as far as this country is concerned. And how do we go along with a system where things have not gone bad? They have been our customers for 15 years, 20 years, but does not have the rating, the threshold rating which is necessary for us to continue this credit. But for this blip, I think we did not have a problem as far as the credit is concerned. Although we were taking conscious decisions, what needs to be, which sector needs to be lent to or not lent to. So there were overall there were certain strategies which were built, but it was not a complete ban as far as we were concerned. But PCA did have a problem. There is a stigma as far as the PCA is concerned. Now, because of that, one thing which at least prevented Bank of India from doing is that we couldn't go to the market and raise capital, because once you are a PCA bank, the cost of raising capital becomes enormous. So the PCA did have a stigma, and getting out of PCA was important, which we are happy we have been able to do. And then you are talking about the norms. I think I have only one comment about the norms. I think when the bank balance sheet was getting cleaned up, it was obvious that the banks were going to face increasing stress. At that point of time, I was not go along with the logic adopted by the Reserve Bank of India to tighten the PCA norms further. That created a number of banks coming into the PCA. I don't think it is to the credit of any system to say that half the number of my public sector banks under PCA. So probably there I hold the view that we should have been more nuanced, but other than that, I think I have no fundamental problem, or at least my bank did not face a fundamental problem because there was no blanket ban on credit expansion.
Madan, would you agree with Padmanabhan at least partially that PCA was a remedy that was worse than the disease? And post PCA, even if the banks have come out, the fact is that they will all want to do only retail lending, lending to the services sector. So what happens to the huge demand for things like infrastructure?
No, actually, I don't think so, because if you look at the PCA, I think we require to have a PCA framework, and we need to make sure that banks are cognizant of the fact that in case they're going to slip up on certain parameters, they would be coming under PCA. Now, has the RBI done the right thing? I think it's been the right thing, and the fact that 3 banks have come out of it means that they're obviously flexible on the issue of PCA. And we should remember that there's an alternative platform which is being worked on developing the corporate bond market. Both RBI and SEBI have worked on it to make sure that for infrastructure requirements or any other long-term requirements, borrowers are moving to the corporate bond market. So I think the two of things are working in parallel. And maybe for the PCA, we can have a single norm of just about the capital adequacy ratio to sort of encapsulate everything which makes you a PCA bank, rather than having it at 4 or 5 stages, which is the way in which it's been defined. But I think having such a framework is definitely necessary, because it brings about a discipline, and making it flexible also is good, so that banks are able to move out and we're able to get back to normal once conditions improve.
I think I'm far more skeptical of the entire PCA framework than Madan, certainly. But Padmanabhan, another issue is mergers. Mergers have often been seen as an answer to improve the state of public sector banks. Though the reality is that, frankly, I feel it's only a cosmetic change. If you put one good apple and one bad one together, in all probability, you'll have both apples becoming bad. Yet there is a somewhat naive faith in mergers, given the problems that a merger actually entails. Why is so much importance attached to it? And do you see more of that happening, Padmanabhan?
I think I'll answer the question from the last point that you made. Do you see more of it happening? I think I see more of it happening. Why do I see this? I think it makes little sense for several public sector banks to be mimicking the same kind of operations and taking on the same kind of risks on the balance sheets. Having said that, I agree with you that the merger is a more strategic issue. It is simply not merging the balance sheets of the banks. You will have to make sure that you pick up the right candidates for merger, because as a result of the merged entity becomes stronger and they get strengthened where an individual entity had weakness. So, in short, it's a much more strategic issue. In fact, in an earlier occasion, I had made this point that normally a merger has to result in 2 plus 2 giving a number which is more than 4. But at least we have to make sure that 2 plus 2 does not give us a number which is 2.5. So, this is a strategy which needs to go in while choosing the candidates for merger. But I think overall we have too many public sector banks, I mean, in terms of size, and its time has come for us to take a relook at the entire space and see whether we can consolidate this into stronger entities. Ultimately, please remember that whether it is a recapitalization or merger, this is a view taken that as a result of this, in future, whatever money spent today or the effort spent today is going to give us a better return, and that's what the policy making is all about.
I would agree with you there. That is the hope. But very often we're treating things symptomatically rather than getting to the cause of the disease, the problem. So, Madan, let me now turn to the issue of governance reforms of PSBs. Do you think that the problem with PSBs and the reason why they are in this mess is because of the ownership, or do you subscribe to the belief held by the former RBI Governor Urjit Patel that this is intrinsically linked to the fact that RBI doesn't have enough powers? Or would you agree with that, given that the growing signs of rot in public sector bank gives lie to this belief? Ownership has nothing to do with it, nor does RBI's so-called disparate powers have anything to do with it. What is really the problem as far as governance of public sector banks is concerned? Madan?
No, in fact, I think the problem here, or rather I would say the issue, is that it's government ownership. And therefore, even when we were talking of this issue of merger of banks, to my mind, I don't think it's going to be much of a difference when the governance structures, ownership structures remain same. So that's one of the reasons why I think that governance is something which has to be taken up. And even when we had BBB which came up, which has turned out not to be as effective as what one had conceptualized, we have seen that the structures really haven't changed. We still have a case of certain mandates being given that you have to do Jandan, you have to do Mudra loans, so when you have to do SME loans. So when these kind of instructions come for the public sector banks which are not actually applicable for private sector banks, I think that's where the problem arises, and that's where we've had the issue of the NPAs for public sector banks also arising when we had the infrastructure issue coming up. So I think this is something which will have to be, I mean, it's an ideological issue. I don't think there's an easy answer for it, but it is something which will have to be sorted out when we are talking of governance.
We're running out of time. So let me ask Padmanabhan one quick question in response to Madan. Padmanabhan, what is the problem for poor governance in PSBs? Government ownership or RBI's disparate control over public sector banks vis-a-vis private? Very quickly.
Mythili, let me start by making a statement. Having seen whatever has happened in the Indian banking system over the last year or two, I would make the statement that as far as the Indian financial sector is concerned, governance is ownership neutral. I think the governance problem has happened in private sector banks, it has happened in public sector banks. And I would not go along with the statement stating that because it was the ownership issue which made the infrastructure loans go sticky. No. I think the infrastructure loan, first of all, we can ask the question whether the bank should have gotten the infrastructure funding at all. There was no way, because there were no alternate methods for funding infrastructure when the country badly needed the infrastructure. So, the public sector banks got into it. Now, I do not say that all were hanky-dory, but many of the problems that the infrastructure which made infrastructure loans NPA had nothing to do with the sanction, it had to do in many cases with the external issues. So, I think we need to take a more balanced approach here. Yes, governance is an issue, but governance is an issue across the spectrum as far as the Indian corporate world is concerned. We will have to take that on board and set it right. Now, I would say that many of the things, whether government should have the 80%, 90% ownership, probably not. Government could think about the golden share concept. This is something which I was thinking about, and they could allow many of the things which are probably there is less freedom for the public sector banks to function, and those freedom being given. Now, I think we need to ask the fundamental. I would make this suggestion: pick up a public sector bank, give them the same kind of freedom, one, just as an experiment, give them the same kind of freedom that is available to the private sector banks to see whether they are working as well as a private sector bank. Then you come to the judgment whether it is the ownership which is the problem, which is the HR which is the problem, or whether it is the operation is the problem. I do not think we can take a view that because there is government ownership, everything is wrong as far as the public sector banks are concerned.
Absolutely, Padmanabhan. I couldn't agree with you more, being a former public sector banker myself, but you were silent on the fact whether RBI is also responsible in some way for the fact that public sector banks, the affairs are not so well run, but nor are they in private sector banks, as you pointed out. But I'm afraid we've run out of time completely, so I'll have to end this discussion now. Thank you so much, Padmanabhan and Madan, for joining me in this very interesting discussion and trying to figure out what does the silence in the budget speech mean about the future of public sector banks. Can we hope that everything is hunky-dory? Let's hope so. But I'm afraid for now, we'll have to reserve our judgment. Thank you so much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.